Well, Canadians are certainly feeling the pinch from inflation and higher than normal interest rates. But what can they expect in the months ahead? Hey there, you're listening to the Brief, an Alberta Better podcast series. I'm Brittany Brander, and in this series, my co-host Scott Crockett and I explore Alberta's big challenges, celebrate those stories of growth, innovation, and prosperity, and discover bold ideas to make life better for Albertans. And on today's episode, we speak with Dominique Lapointe, Global Macro Strategist on the Multi-Asset Solutions team at Manulife, for a deep dive into Canada's economy and how we are faring. We discuss the Bank of Canada's recent decision to hold interest rates, wage growth disparities between Alberta and the rest of the country, how businesses are faring in the current economic environment, and what Canadians should be paying attention to in the coming months. If you found this episode insightful or interesting, let us know by heading over to Apple Podcasts or Spotify and give us a quick review and rating. Now on to the show. Well, Dominic, welcome to the show. We're really, really excited to have you on the show talking about wages and inflation and, global economic expectations and all of those fun things. But before we get into the meat of our conversation, can you just share with our listeners a little bit more about who you are and what you do?
Yeah, for sure. Thanks for having me on. So I'm from Montreal, studied economics and worked in economics now for 10 years, mostly talking about the Canadian economy and Canadian financial markets. So that gave me the opportunity to, travel a bit around across provinces and try to learn a bit about the industries and where different peoples do things. So it's a great knowledge to bring to Manulife now, where we work, about what we do. We're a big company. We have a bank. We're also an insurer. But what we do here, we're an asset manager, and on my team, and we try to provide what we call portfolio solutions to our clients, where they're going to have specific needs in terms of returns for pensioners, for example. They want to target a specific return over many years, and so what we try to do is provide them those solutions. And our team, with my colleague Francis Donald, that you had on the podcast before, we do this from a macroeconomic perspective. So we look at the world, look at those macroeconomic trends, and we try to apply them to the portfolio management. So that's how we fit in the whole thing.
Well, that's a perfect lead into what we want to talk to you about today, Dominic, which is a bunch of macro trends. We want to talk about kind of an all points bulletin on the Canadian economy with a bit of a dive into Alberta. And maybe I'll start with one of the biggest macro trends that we've all been thinking about a lot over the past year or so, which is the Bank of Canada's rate decisions. And so as of the bank's most recent rate decision, they decided to hold steady at 4.5% for the overnight rate, diverging a little bit from what the United States has been doing as of late. What's your personal view on this, Dominic? Was this the right decision? Has the bank done enough to cool inflation, or would you have a different prescription?
Yeah, it's very hard to talk about like good or bad decision in these cases, because the outlook is so uncertain, and we'll know in a couple of months if this was the right decision. But I hate this, but I'll make like a hockey comparison from my former boss at BC Research, where he's saying, you're not trying to pass the puck to where the player is right now, right? Because you're going to miss. You try to pass the puck where the player will be, like in a few seconds. And I think that's what Bank of Canada is trying to do. I think that's what they should be doing, which is, where is the economy be like at the end of the year? Or where will be the economy in 1 year from now? And you're basing your interest rate decision where you want interest rates right now to be based on where you think the economy will be going or reacting to these levels of interest rates. And so my point is, where we think we're going is probably inflation. Inflation has started to cool off, still way too high, but the trend is there, and we can go way deeper about that in a second. But if you assume for a second that it's going to be quite lower in a year from now, that's the first point. Second point is, where will just the general economy be at these level of rates? And there's early signs that the global economy is slowing, the Canadian economy is slowing. So, will in some industries people have less hours to work? Well, in some industries people have lost their job. It's quite possible. Unfortunately that's something that we expect on our team. So if you combine these two elements, well, it does make sense to leave rates unchanged and see how this unfolds. If it doesn't, and you see, well, the economy is just starting over, well, maybe we misunderstood how interest rate react with the economy, which would be some kind of recognition from economists. But at these levels, I think it makes sense to hold off and see how things evolve.
Well, and let me ask you about where you think that player is going that we want to pass the
Yeah.
puck to. So, you can't predict the future, Dominic, but in terms of what you might expect the bank to do over its next few rate decisions, based on what you're seeing today, do you anticipate that there'll be this period of sort of cautiousness and a pause, or do you think that we'll see the bank making more drastic moves in the next few months?
So that's a great question especially with the Bank of Canada, because I think they're reacting a little bit different and they have been over the past year than what the Fed did, for example.
Mm-hmm.
So now they're on pause, right? As we said, they've been on pause since January. But when they paused, they said, we think that the Canadian economy will significantly slow down. And I just said, I also think it will slow down. But to be honest, it really hasn't. Like we haven't seen really, you look at consumption, really elevated. Construction started to decline a little bit, but it's still pretty strong. And we can talk about the labor market. No signs of weakness, no signs of any respite in terms of job creation, wage growth. So when we go back 3 weeks now in the April decision, I think they got worried that the decision to pause is not impacting the economy the way they want, which is slower. And if we look over the coming months, if we don't see any sign of those slowdowns yet, which would be really surprising, but it's still possible. If we don't see those signs, I think there's a real risk that they feel they have to do more, which would mean another hike, another hate hikes, 2 more. I don't think that would be, considering what I just said, like you need to look at where we're going to be in a year, not necessarily in a month. I don't think that would be the decision to take, but I think that's one that they would consider.
Right. I know that our economics team here at the Business Council has sort of been preaching a level of caution or waiting and seeing. It's our feeling that we haven't even fully felt the impact of all the rate hikes thus far yet, and in terms of working their way all the way through the economy.
Yeah.
That doesn't necessarily mean that there absolutely shouldn't be future hikes, just that, a note of sort of caution as we look towards it.
Oh, definitely. And I'll quote like two facts about that. Many people have variable rate mortgages, right? And what we've noticed over the past couple of months is that banks want to be lenient. They want to help people like not having issues paying their mortgage. So they're saying, even if right now your monthly mortgage payment doesn't even cover the interest, we're going to let you extend the amortization period. So in fact, like putting negative principal on your home to avoid the financial hardship. But this has there's a limit to which you can do that. At some point, you need to refinance. And there's some regulation about bringing this back over 25 years total, not 50 as it is now. So unfortunately, we're in this sector, maybe we're kicking the can down the road and raise interest rates even more. That will further exacerbate the problem that will come. The second stats I'll mention about the slowdown, we've seen last week data from the superintendent of bankruptcies showing, and it's a low number, like an absolute number, but it's still the number of Canadians calling for a proposal on their debt. They want to restructure their debt because they have a hard time paying it. That's a record high. Since we collect that stat since 2011, there has never been that many Canadians trying to restructure. So slowly we're seeing signs that interest rates bite for a small number of Canadians. But if you add on to that more global slowdown, a more broader slowdown, where you'd see, for instance, consumption slowing down because people want to save more. And so people just going less to the restaurants, people not wanting to buy that new car anymore, that can lead to a sharper slowdown.
How badly do you think Canadians are feeling the pinch of higher interest rates now? You mentioned that stat on bankruptcies or debt restructuring. From your sort of macro perspective, how squeezed are Canadians? And in particular, you're talking about the sort of restructuring of mortgages to be paying even less than the principal. Is that something that's happening a lot or just a little bit?
We're not sure because it's not, I'm not going to go into who does that or not, but we know that this is something we've noticed. We don't know, but for how many Canadians, but it's a practice that's being done. But to your more general question about how it hurts Canadians, so far, I see the stats that I've mentioned are really concentrated into a small number of people. which you can say it's good, right? It's not systemic. But the fact that it's there is still concerning. We came out of COVID and remember all these very generous transfer programs, maybe kept there for too long. But we don't have to go into all the details of that. But many people had some, what we call now excess savings. So if you look at how many they saved during the pandemic versus their income, way out of line with what it was before. So that fueled consumption, right? Consumption at a time where also goods were very scarce because we can reproduce them. So we're coming out of COVID. Many people retired during COVID. So labor shortages, stronger wage growth. It's when you're a worker, it's actually a good situation. You can actually, there's plenty of job opportunities. You can change job, ask for a big raise. And so that's why I think when you start raising interest rates a year ago, even if you go fast, they went really fast, the Bank of Canada, takes a while in that environment for consumer, the people actually have a job and really feel it. Many people don't have a mortgage. That's something that we also need to recognize. It's not only about people having a mortgage. Maybe you don't, maybe someone don't. People rent. So that's why it's a slow process, right? And that's why I'm saying where we see weakness now, distress now, it's really into smaller portion of Canadians that unfortunately maybe they took on too much debt before. Their situation is different. But my point is, project yourself 12 months from now, then that pool of people will grow. And that's where it will be more concerning.
So inflation has been for a long time kind of at that 2% band or so, which is something that we would expect and kind of that would be like our goal, right? Do you think that we are maybe entering a period of higher inflation for a while as opposed to what we've been used to?
I think it's going to be different. Yeah, for sure. For many, many reasons. Some of them are, I'd say, cyclical. And I'm coming back to labor shortages. If you look at what's happening with inflation now, what drove down inflation from, I think we reached 8% in Canada last year, the record, and now we're a little below 5. We'll have some stats about that on Wednesday. It's mostly goods. So people bought a lot of goods, shortages, and now when you ask retailers or manufacturer about furniture, about electronics, about just general items, they're overstocked, right? They want to get rid of those inventories. Same thing with car prices just exploded. Used car prices exploded. Now they've come down a little bit. So that's what's fueled down inflation, right? When we're talking about disinflation, mostly came down from goods. The issue, and that's what I'm getting to your question now, the services, right? That personal care, professional services, leisure and entertainment, going to the restaurant, that's where a lot of the input costs for a business is labor, and you're missing labor. And we're not like, we can go into we're getting more immigrants in Canada now. The population is growing fast. But even with that, it's very, very hard to fill those positions now. And from a cyclical perspective, and maybe it's even structural, that will make it harder than in the past inflation cycles to get back inflation. If you want to go to 2%, this is going to make it hard to go back to 2%. From a longer term perspective, and that's maybe another question at all, but climate change, geopolitical tensions, those are even harder to model and measure, but we can be certain that they will lead to more uncertainty about inflation.
Do you think that some of those structural changes like COVID, climate change, digital disruption, just the shift of economic value from what we produce to kind of how we do the things from like goods to ideas, do you think that is having or will or even should shift how we think about interest rates and how we think about inflation going forward?
Yes, but unfortunately, my answer will be boring, is that I don't have an answer. I don't have like a definite answer on which one will do which over the long run. It's so early. If you think about COVID, like I think one thing that is staying is work from home, some capacity. Like right now, I'm at home.
We're doing this podcast remotely, and oftentimes in the past we've done it in person. Yep.
Yeah, and when you ask people, do you feel you're more productive at home or at the office? Everyone's giving a different answer, different vibe, different focus. So we need productivity, and work from home is staying. So what is the long-term impact of work from home on productivity? And maybe is this going to stay? So that's one question. Same thing with AI. Over the past 3 months, we've seen all these great chat bots. Everyone is saying this will have a massive disinflationary impact. Okay, but now ask yourself, if you replace workers for robots, well, what are these people going to want to do? Are they going to be happy? Are you going to have to provide some form of support for them? Will the government have to step in? Going back when many people lost their job in the US because a lot of it was because of globalization, many of jobs were transferred in Asia for lower cost. You can say it was disinflationary for sure, but it had other social impacts, social costs that in the end maybe cause more inflation, like people being on disability programs. So it's weird to say, but for sure it will have an impact.
Yeah. I like just two really random interest rate related questions. One is on bank collapses. So this is another phenomenon that we've been seeing. There's obviously a little bit of nuance to this, but by and large, if interest rates probably weren't as high as they were, we likely wouldn't have seen the collapse of Silicon Valley Bank. So if these high interest rates persist, do you think that we might see more bank collapses in the future? And then the second question there is, what about in Canada? Do you foresee some of that happening in Canada, given that our banking structure is maybe a little bit different?
No, that's a great question. So let's stick with the US to start with. So I think one thing that propelled the initial failure of SVB, which was the initial one that also caused the other failure, was when many people realized losses that were not marked to market. And so when they actually did it, people got scared of these unrealized losses. Fact of the matter, if you hold on to these assets until maturity and they don't default, those were bonds, right? And they would probably not have defaulted because a lot of those assets were in treasuries. Then there would be no real losses on the assets. So my point is, there has been a lot of scrutiny put on the banks in terms of what are those unrealized losses. And so I would be surprised if there's a new big revelation that says, well, we found out way more. Like there's been a lot of scrutiny. Doesn't mean there will be no other failure. And I'll tell you why. And that's coming from Matt Levine at Bloomberg. I don't know if you follow him, but his point is that now when Credit Suisse was bought by UBS, you can look at the stats from the Fed, and they're showing that deposits are stable. Like people are not pulling their money out of small banks anymore. They stabilize the system. Also, the Fed did this new program that helped stabilize the system. But the stock market doesn't agree. And even like last week, we see huge swings into regional banks. Stock market is skeptical. And the fear is that if you're a normal depositor at these banks and you're seeing the stock market of your bank going down like 50% or being altered for trading, maybe you're going to think, well, my bank is probably in trouble. So maybe I got to take my money out, despite the fact that there isn't any issue with the bank, right? So that's the fear, is that right now, the dynamic, it's a shorter dynamic that could settle down as we speak, but recent dynamic that scares us is stock market doesn't agree with the fact that the situation should be resolved, and that could cause the problem that we want to avoid. That's the first part. For Canada, it's a different situation. Canadian banks, they've always had the higher capital ratios. So in terms of how much equity, how much capital you can have to offset those liabilities. And right now, that ratio is at a record high across banks. So we don't see the same kind of, even if you make the math, you don't see the same kind of, any kind of insolvencies that you would see into some of these smaller banks. Second point is Canadian banks, 6 large, couple of smaller ones, but in terms of our GDP, they're not even close to be as small as some of the US banks that we see trouble with. They're by nature more diversified, right? And so the original problem, or the original fact that maybe caused SVB to collapse was it was very concentrated into an industry of venture capital in California, right? Same thing with some of the other banks, some exposure to crypto. So Canadian banks don't have nearly the same kind of single exposure to a volatile industry. The only concern that I would have with the banks here, and that's why they're highly capitalized, by the way, like OSFI knows that, government knows that, is we depend a lot on the housing market, and we depend a lot on people paying their mortgage. That's a big factor driving the book at the bank. So we don't think that this situation will get out of control, but that's the risk for Canada that we don't really see for the US in terms of banking exposure.
Right. And just for our listeners, you said OSFI, that's the Office of the Superintendent of Financial Institutions.
Yeah,
right?
I'm sorry, the bank regulator in Canada. Yeah.
Not always an everyday acronym for everyone.
Yeah.
So if you permit me, one last random question on interest rates. This is something that I have been interested in, just personally interested in for a while. So The Economist a while ago came out with this article that reported 35% of Americans believe that inflation is driven by corporate profit, corporate greed. But they also noted that the narrative doesn't necessarily line up with the facts.
Mm-hmm.
So I'm curious, why do you think that narrative has prevailed? And to what extent do you think profits are, contributing to in inflation?
It's very hard to know, but the perception, because it's true that profit margins are elevated, right? And they came off a little bit, but they were elevated coming out of the pandemic. But the idea that this is something that is meant to be at the detriment of the normal consumer, I think comes out of the real perception that income inequality have risen. And that's why I'm asking, when was this collected? Because maybe if we asked the question 10 years ago, we'd get the same answer. That in the US, especially in the US, coming out of the great financial crisis, took a while to get all these jobs back. Like, we don't remember now because the labor market is so tight, but the US unemployment rate dropped very slowly out of the great financial crisis, and income inequality exploded. People lost their home. So the idea that's maybe more of a personal opinion, personal interpretation of why they would answer this, but the idea that some people are benefiting off and that explains their situation, I think it's rational. It makes sense. Are the facts saying this? Maybe not as much as what they're implying, but I think the perception comes from a true fact that income inequality has risen.
Let's move to wage growth and labor markets. Tell us a little bit about what you think is driving wage growth for Canadians generally. Yeah. And then I'd like to dive into Alberta a little bit too, as a second part to this, because the truth is Albertans feel like perhaps we've been feeling inflation harder than most other Canadians, that we feel the same inflation, but wages have not been growing as quickly in Alberta.
Yeah.
So tell us what you think is driving it in Canada, and your view from the outside. Why has Alberta not seen the same wage growth as the rest of the country?
My answer will be a bit boring for Canada in general, because I've said that what drove wages was probably labor shortages across most and retirement. Also, the fact that just in terms of population growth, now it's accelerated, but it's still somewhat slow. And even the people coming in, if you did a job back there in your country, you're probably not going to be able to do it right away here. You need to get the permit, you need to get the recognition, maybe you need to go back to school. It takes a while to actually get those jobs. So if you look across the industries, the labor shortages we faced before the pandemic was in very high qualification jobs, tech, finance, medical care, but qualified medical care. And these shortages are still there. But the shortages we created during the pandemic was in lower qualification. What we usually see lower qualification, which is maybe younger people do, or people that are in school. So food and hotels, restaurants,
hospitality,
working at the grocery store. And another factor outside of retirement that made this problem worse was the fact that during the pandemic, people didn't want to do these jobs. And there is in some level there, the government would say, well, you don't have to, because if you don't work, we're going to send you a check, right, to support you. So many people just say, I'm going to go to school. I'm going to change industry. That's a fact. And that's a shift that was partly reversed, but only partly reversed. And that's what I'm saying. We had a problem with higher qualification, and now we have another problem with lower qualification. These people are missing. And that's why across industries, wages are strong. You need to, right? If you want to keep your workers. So that's one thing about Alberta. I think it's fascinating because I've looked at the statistics before conversation. It's true, it's the lowest wage growth in the country. Now you look at the three provinces with the highest wage growth. So Ontario, BC number one, Quebec number two, I think Ontario number three. And one reason, I'm not sure about all the reasons, but one reason that historically we've known about Alberta is that it benefited from interprovincial migration, strong international migration, right? So Alberta has younger population than in other provinces. And that's something that has been benefiting to the province. And so when I look at these wages, well, maybe the fact that Alberta has slightly younger population, well, these people can actually fill in these positions that impossible to fill them, let's say, in rural Quebec. No one's there. But maybe in Alberta, there are these people that are at this age, at their stage in their life, and they can fill this position. And I'm not there. I'm not in Alberta now, so it's hard for me to be sure. But that's one suggestion I would make.
One of the hypotheses about it is the younger age demographic structure of Alberta, but actually leading people into some of those lower wage jobs.
And I have a stats to back that up. I also looked at the jobs vacancy rate, which is a number of vacancies per unemployed. And this is actually lower in Alberta than way lower than in Quebec or BC. So depending on the industries, it's probably a fact that there are people to fill these maybe lower qualification jobs in Alberta than we don't have in Quebec. And that could explain why the wages don't need to be as high in terms of growth as in other provinces, because we're also talking about growth here, not necessarily the level or your living standards.
Because Alberta has historically actually had higher wages comparatively than most other places in the country. So,
higher income per capita, exactly. So in terms of how well you can live, maybe wage growth being lower doesn't translate into you're not having the same standard of living at the moment.
Right. I want to ask you about some tweets that you sent recently. You were
oh my god,
that's the scariest thing for anyone.
What did I say? I tweeted like
nothing crazy.
Nothing. Okay.
The Bank of Canada.
The recent Bank of Canada Business Outlook survey, this is something we find very interesting because we do a Business Outlook survey in Alberta. But what can you tell us about how Canadian business leaders are feeling right now about the economy generally, their forecast for growth in their own business?
It's interesting because with all the not doom and gloom, with all I would say a little bit pessimistic outlook that we share as a team at Manulife, and not only us, but maybe many other shops. When you ask a business leader, the situation is still good, right? They're saying their sales outlook is negative, but it's coming off from such a high level that it's not at a point where they feel they need to reduce hours for workers or even let people go. And that's probably the worst, and I'm quoting here, for probably the worst thing that you'll find in that survey. When you ask them, what about supply chain? Well, they've improved a lot. It's no longer a problem. Okay, that's good. Even labor shortages you're mentioning the Business Outlook survey, they're saying it's still a very big problem, but it hasn't gotten worse. So it's stabilized. Same thing for their input cost. It's lower now. There's still like very elevated output costs of people feel it when they go buy stuff, but their input costs or their outlook for where prices are going has also moderated. So at the moment, businesses don't seem to be as worried about the economy that economists are. So maybe there's a little disconnect here.
Yeah, business is not as worried about the economy as the
which is interesting.
Yeah, you have to be a bit of an optimist, I think, to be an entrepreneur, to run a business. About another macro trend, recently on this podcast, we had the geopolitical strategist Peter Zeihan on, and he was talking a bit about deglobalization, friendshoring, this movement to see maybe some more industries and some more manufacturing come back towards North America. How significant of a trend do you anticipate that being over the next couple of years? And is this something that Canadian business leaders should be looking at and banking on?
I do think that recent events in the world, the war in Ukraine, and the tensions between the US and China are game changer in terms of how we should see geopolitics evolving, in terms of how advanced economies really, really believe that more globalization, more interconnectedness is what the strategy should be. Other concerns such as, do we have the commodities, the resources to be a little more rely a little bit on themselves and not necessarily on many external partners that we can have like a volatile relationship with. I think that's something very concerning. You've seen the U.S. administration, the Biden administration, coming out with this very elaborate plan to what do we need? We need chips, we need critical minerals, we need energy. Very elaborate plan to develop those industries, and I think the theme of deglobalization comes from that push, right? And it does happen. We're a great business partner with the U.S. We're reliable, so Canadian businesses should look into that. And also does happen that we have most of these minerals and and resources that they need. But I'll say, right now, the Biden administration also has a concern with climate change and wanting to produce clean energy, and the European Union has also this concern, has been concerned for a while. So Canadian business leader needs to think about the resources and how they can offer these critical minerals and energy, but also need to think about it from a sustainable perspective. Make the case that this is a sustainable way of producing these resources.
Mm-hmm. What other challenges do you think that business leaders are going to have to navigate as, more of these global trends kind of peek their little heads out of the sand? And we put more pressure on the global economy, job markets, wages, etc.
Uncertainty. It's a boring answer, but that's unfortunately that's what everyone has to face with since COVID. From our perspective, we used to argue about, will real GDP growth be 1.8 or 2% this year?
Right.
and now we're like, is this going to be negative or 3%? Or will inflation be 5%, or we're going to get zero inflation because we'll have like a massive depression? You see, these are the conversations that we have to have now. Very often we used to have the variance of what we used to discuss is explode. And that's the same thing for business leader. And I'll go back a couple of years. Business leader for a short period of time had to worry about NAFTA getting canceled.
Right.
That's not something everyone would have thought about 20 years ago, but that's something that maybe came close to happen.
Mm-hmm.
We don't appreciate it. So now it's a different relationship, but these things could come back, and they could come from other regions that we had good relationship with. These things can change quickly. So getting prepared. And we more like international companies now, I think they're thinking about redundancy more than efficiency, which is probably a good way to think about uncertainty, because if something happens, then you have a backup plan, you're prepared, you don't rely on a single supplier for something. So that's how I think business leader will think in the future.
I think that's a good point, that almost like the tree of possible outcomes that you need to plan for used to be much more narrow. You joked, is GDP going to grow 1.8 or 2.1%? And now you have to plan for this enormous sort of tree of possibilities. I think you've touched on something important there as well, that good business resiliency often looks like bad business efficiency. If you only need one computer to do the job, well, it would be very efficient to only have one computer, but then you're not very resilient. So you might want to have actually a backup or a backup to your backup, but then you would have 3 times as many things. And so I think that's one of the periods that we're in right now, where businesses are actually willing to sacrifice some efficiency, sacrifice some just in time, in order to be more resilient to this sort of larger tree of possibilities that they need to be planning for.
100%. Look at the number of companies making chips in the world, or chips at the sophistication that you actually need in cars, in anything electronics we have, and now in appliances. Very, very few big companies do that. And so now what governments are thinking about, and also what businesses are thinking about, is how can I make sure that I have the supply when I need it, instead of just assuming that the single supplier, because it can scale up, is the best way to go.
We covered a lot of ground in 40 minutes.
Yeah.
So as we come to the end of our conversation, we just want to ask, is there one insight or idea that you would like to leave our listeners with? If there's one thing that they take away from this conversation, what would you like to have rolling around in their brains?
Yeah, I think I've said it in like 5 different ways, but things are changing. Things are changing quickly, and I think people need to look ahead. You know, in what industry are you working on right now? Do you have a mortgage? Do you want to get a mortgage? When is it going? Good moment to do it. I think preparing a little bit more in terms of financial, in terms of life decision, I think is something unfortunately more relevant that maybe it used to be with when everything looked a little more stable and predictable.
Mm-hmm. Well, I think that's a fantastic insight to leave people with. Thank you so much, Dominic, for joining us.
Thank you, guys. This was fun.
Well, thank you for joining us for this episode of the Brief, an Alberta Better podcast series. This podcast is a production of the Business Council of Alberta. You can learn more about us at businesscouncilab.com, and we'd love to connect with you on social media. So give us a follow at BizCouncilAB on Twitter, LinkedIn, TikTok, and YouTube. And finally, don't forget to subscribe and rate the show and give us a quick review. Your support helps us to keep making more of these episodes. Alberta Better is available on Apple Podcasts, Spotify, or wherever else you get your podcasts. New episodes drop every other Tuesday. Thanks for listening, and we will see you next time.